I think that the pandemic will have this very long lasting impact because it unleashed so many other issues. It basically let the tide out, and we began to see some other problems that had been developing.
Abby Joseph Cohen is next on Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of our very first guests on Wealth Track 20 years ago was a huge get. Abby Joseph Cohen, then the famed U.S. chief investment strategist for Goldman Sachs, joined us when we were just beginning. She is still a huge get, and she joins us again this week for the second of a two-part interview. In case you missed our first discussion on the U.S. markets and economy, you can see it on our website, wealthtrack.com. Abby Joseph Cohen is now a full-fledged professor at Columbia Business School, where she started teaching as an adjunct professor in 2014. Joseph Cohen retired as a partner from Goldman Sachs in 2021, where she had numerous leadership roles, including president of the firm's Global Institute for 6 years, and before that, her famed role as its chief U.S. investment strategist, where she was regularly ranked as one of the most influential thought leaders in the financial industry. She remains a longtime member of the prestigious Barron's Annual Roundtable. Well, this week our focus is on global risks. It's a topic she knows well because she's teaching a course on it at Columbia Business School. The title of her current course is Structural Disruptions in the Global Economy, and it is perfect for us as we celebrate Wealth Track's 20th anniversary because, as the description reads, the course delves deeply into the critical events of the past 20 years that have permanently changed the structure of the global economy, focusing specifically on the impact of financial markets and financial policy. I asked Cohen which of the many critical events of the past 20 years has had the greatest impact on the global economy and markets.
A fascinating question, Consuelo, and we won't know the answer for another 20 years or so, but let me hazard a guess. I think that the pandemic will have this very long-lasting impact because it unleashed so many other issues. It basically let the tide out, and we began to see some other problems that had been developing. So it wasn't just dealing with the illness and the problems associated with that. It was also recognizing that the inequality in our economy and other economies as well was creating an uneven consequence with regard to how different populations were faring. And so, for example, many of the people, such as myself, people watching the show, for example, had the flexibility to work from home. And the consequences of the disease were lessened. On the other hand, what we began to see is that people, middle income and lower middle income, who worked in the service economy didn't have that flexibility, higher mortality rates, higher sickness rates, and so on. The other issues that became very apparent as a consequence of the pandemic, economic in nature. Many people never thought about the supply chain before the pandemic, didn't really think about the dependence that had been built up during that period of globalization. Many people, most economists, viewed globalization as a net good for everyone involved. It created jobs around the world. It kept costs down in the nations that were doing the importing and so on. But of course, we found that when there was a disruption in the supply chain, things were not looking quite so well. I don't need to go into all the details of the problems that we faced, whether it had to do with personal protection equipment, availability of medications, and the like. But we also began to worry about what would happen if the supply chain was intentionally broken. For example, our dependence as a nation in the United States on foreign imports, that is, imports from other nations of technology product, including chips, including batteries, and so on. It's something that raised our awareness of this and made us perhaps more willing to accept somewhat higher cost than we otherwise would have done.
One of the things that I know you're addressing at your Columbia Business School class is the monetary and fiscal stimulus. When you think of the global financial crisis, there was unprecedented monetary stimulus, and there certainly was some fiscal stimulus as well. You get to the pandemic, and it was on steroids, and we're still living with government debt levels that are at record levels at this point. So how much of an impact do those policies have, and will they still have, and what difference do you think they will make to the economy and the markets?
I think we're beginning to see them unwind, and that's quite important, Consuelo. We certainly have seen inflation become largely under control, again, not totally. What we need to make sure is that government spending going forward is, in fact, largely focused on investment. There's something wrong when you have, for example, the Federal Reserve feeling as it needed to raise interest rates at the same time that there was a lot of fiscal policy stimulus.
Right.
You don't want them working at cross purposes with one another. And what I'm hoping is that as we move forward over the next couple of years, we'll be in a situation where the Fed doesn't have to do too much in the way of stimulus. I think they're going to do more than they have done thus far. And that the amount of federal stimulus that we do is highly targeted, isn't just, kind of like thrown against the wall, as one might argue happened at the beginning of the pandemic, just to make sure that we did not stay in that very severe recession. In addition, what the pandemic unveiled had to do with the supply chain problems that
Right.
we were facing, and also unveiled some of the problems in terms of global cooperation. And one of the things that I watched very carefully is that there were some nations with whom we participated in a very effective way. And so, for example, the sharing of information, the sharing of vaccine technology with a handful of other countries, I thought was really quite amazing. So the United States, along with the UK, Israel, Australia, Canada, and so on, very, very impressive. And I think it sets the stage for, I hate to say it, the next pandemic or the next medical emergency.
And as far as deglobalization is concerned, so you're saying that the pandemic kind of revealed it and accelerated it. So where are we in the deglobalization process, and how far is it going to go, and what kind of a risk does that present to the economy and to the markets?
What we have seen thus far is not actually a dramatic deglobalization. What we have seen is a reordering of where we are doing business and where we are putting our next investments. And so, for example, we have seen something called nearshoring or friendshoring, in which some productive capacity has moved out of Asia and has moved into Mexico. Some of it has moved back into the United States. But curiously, the amount of global trade really hasn't gone down very much. The countries that we're dealing with have gotten reordered to some degree. And I'm certainly aware of the fact that some of what we are importing from Mexico and other places in Latin America may have been connected as well to China. But what we are seeing has been, I think, a more thoughtful approach in terms of companies at least understanding where the full extent of their supply chains are. What I do worry about would be the inappropriate application of tariffs. Tariffs are almost never a good economic policy. You can use them in instances where another country is dumping. For example, there are instances where China is now producing more than total global demand for some products. This includes solar panels. And that may, in fact, be a very good opportunity for other countries to apply tariffs. But in instances where tariffs are applied just across the board because it'll be a source of tax revenue for the United States, that doesn't work out well. It's inflationary. It cuts back economic growth. And the countries that are most adversely affected, based upon various models I've looked at, are not the countries that we want to politically target. It very often is our friends. The United States does more trade in North America than with any other country, right? It's our buddies in Canada and Mexico.
You're advising some government entities about economic and financial risks. So what are the risks that you are looking at?
One of the risks, Consuelo, is something that we've spoken about here, and that has to do with the concentration of investment in the United States, not just towards technology, but towards a very small number of companies. It is very concerning when you have so much investment, be it portfolio investment or direct investment in companies' research, on a very small number of areas. We have had, as a nation, a move in the wrong direction for the past 30 years. The amount of money invested by our government in basic research, that is not aimed at a particular product or a particular company, but basic scientific research, we're now doing half as much of that as we used to, whether we measure that as a percentage of GDP or as a percentage of the federal government budget. That just is a terrible mistake because when you allow investment to be done primarily by the companies that will directly benefit and directly benefit in the short term, you could be missing out on enormous opportunities elsewhere. We now see, for example, that more than 60% of total investment is going to two industries in the United States. Basically, technology and pharmaceuticals and other areas are being starved. Contrast that to what's happening in other countries. 20 years ago, the United States was number one in terms of not just the amount being invested, but invested as a percentage of GDP. We're now number 12. As the world's wealthiest country, we ought to be doing much better than that. Other countries have lapped us on that. They basically are following industrial policies, which they're saying in the 21st century, the economies that will do well are the ones that invest in K, that is capital and scientific knowledge, and L, labor, education.
How important is AI, and do you see areas to invest in it?
I have, as you mentioned, an undergraduate degree in computer science. I'm on the board of a leading institution that is a leader in terms of teaching AI, and I don't know what the answer is to your question because we are, I think, still at the very beginnings of the AI revolution. Has there been a lot of AI, let's call it greenwashing, where companies say they're doing stuff in AI? Well, yeah. A year or two ago, only 10% of companies in their quarterly statements mentioned that they were active in AI. We're now up to 40%. But when queried, many of them will say, we're trying it out. We're not really seeing the productivity benefit yet from our workers. So we're very early on. Where we have seen a measurable benefit has been in those companies that provide the infrastructure, basically the chips, for example, or the electric utility companies that are providing all of that electrical juice that these companies need, including cloud storage companies. But we have not yet seen the full impact of AI. AI has has actually been around a very long time. We used to call it different things. I have a clothes dryer that's 15 years old that measures, whether stuff is dry enough and it turns itself off when it is. That's a form of AI, not quite as sophisticated as ChatGPT and so on. But we have been leading toward this for a while. What I am concerned about, and here I am speaking as somebody interested in computer science, is the following. We don't quite know how some of these models work when we let them do their own thing, when they're not being monitored by human beings. And so, for example, we still see significant hallucination. That is where the models basically make stuff up because of the information that has been fed into them and how they process it. In the olden days, we used to refer to something similar as garbage in, garbage out.
Right.
With AI, that is happening so much more quickly, and it's much more difficult to monitor and keep control of. But I think that people are now trying to identify what some of these problems could be, as well as the opportunities. Keep in mind that in technology cycles over the centuries, there's almost always this kind of confusing entry point, very expensive, whether it was the railroads where a lot of money was wasted, the early telephone systems in the late 19th century, and so on. Things have to take a while to settle out before we see the real benefit to the companies, but also the real benefit to the users.
Your final course at the Columbia Business School is the long run outlook and the big macro trends that you all are following. And I'd just like to talk about a couple of those. One is that the government debt is at records around the world.
We have seen increases in government debt in so many nations, and there are a variety of reasons for that. Number one, to be very explicit, in democracies, there's always the temptation for politicians to offer something, which ultimately has to get paid for. So that's number one. Number two, during the pandemic, there was very dramatic spending, including here in the United States, to try to get us out of that pandemic-induced recession. Number three, those very low interest rates that we enjoyed for several years encouraged debt. Because if you're not paying very much to carry that debt, why not? And by the way, it wasn't just governments, it was also corporations, and it was also portfolio managers, private equity managers, as one example, who took on a huge amount of debt to lever up their portfolios to make the performance look better. Corporations did something very similar. And so we are now in a situation where the tide has moved out. Interest rates have moved up. I know they're moving lower right now, but they're no longer negative. They're no longer zero. And so there is a cost of capital. And so we are now coming to the point where we need to think more seriously about the debt that has been accumulated in the United States and elsewhere. Now, in the past, how did governments get out of these situations? Very often, they would take on a lot of new debt because there were extenuating circumstances, most recently the pandemic. But what about the Second World War, First World War, and so on? How did nations break that debt cycle? They grew. Their economies grew, revenues grew, tax revenues grew. The need for additional fiscal stimulus became lessened. And so you ultimately, as a nation, grew out of that problem. And one of the concerns that I now see in so many developed economies is going to be hard to grow or harder to grow. Let me give you a fact, and that is for the last 20 years, the United States economy has been the single fastest growing of the major economies. One of the major reasons for that has been our population growth. We have benefited not just from natural births here, but from immigration, of the education and income spectrum. The reality is that the United States has been a magnet for immigrants throughout that spectrum. Almost 2/3 of the working PhDs in the United States right now in areas like science and medicine are immigrants. I want you to think about that, right? The United States has been a magnet for people who want to come here to take advantage of our terrific higher education system, tertiary education system, PhDs, professional degrees, and so on. They come here. In the past, we have allowed them to work. We have welcomed them in terms of working. And now there's a situation where immigrants are feeling less comfortable. That is not to the benefit of the United States. Ours is a nation built on immigration. There are a few other nations like that, like Australia, for example, but we really are very dependent upon immigration because our natural birth rate, while it is better than it is in Europe and Japan and China, it still is not enough to keep our economy growing at the rate that we have become accustomed to.
I'm thinking about the levels of debt that were taken on when interest rates were at these unprecedented low levels, and the companies and the sectors that levered up. What's vulnerable? Are there any sectors in particular that we might want to avoid?
There are some companies that have levered up, but not all of them are in danger. I found it fascinating, for example, when interest rates were extremely low, that it was often the best companies with the strongest balance sheets that levered up and took on very long-term debt, 30-year bonds, 40-year bonds, and so on. So it's not just a question of how much debt is on the balance sheet, but what does that debt look like relative to cash flow? And then it becomes very much a company-by-company sort of analysis. Now, there are some industries that run on debt. Financial services, for example. But one of the things that has been, I think, fortunate, and this is the outcome of one of those other long-term risks that you mentioned, the global financial crisis, is that regulators, financial regulators, especially in the United States, have been pretty tough. I love this tough love where they have really kept a careful eye on the balance sheets of financial services companies, brokers, insurance companies, banks, et cetera. And so I think that they are very likely to have done quite well when interest rates moved up and as interest rates are now starting to move lower. From my perspective, it's actually a positive outcome of the GFC in which the regulators here in the United States, and then, of course, the so-called GSIBs, the globally systemically important banks, have been very carefully monitored. They have much tougher capital constraints than some other institutions do, and I think it keeps the whole system stable.
One investment for a long-term diversified portfolio, you gave us one mid-cap U.S. stocks in the first part of this interview. Do you have another one investment for a long-term diversified portfolio that you will share with us?
I would reiterate my view that it is time for intermediate and long-term investors to think outside the United States again. We have had a period of terrific performance overall by the U.S., outperformance by the U.S. relative to other markets. Other markets now look less expensive than the United States. And by the way, they have exposure to different industries. And so something like the EFA index or some of the others where you get exposure to economies that are now doing better like Japan or the UK or other parts of Europe, Australia, et cetera, that to me represents a very important diversifier in long-term portfolios.
Abby Joseph Cohen, it is so great to have you on WealthTrack again and to talk about your broad scope of interest and research and teaching that you're doing. So thank you so much for joining us again on WealthTrack.
Happy to do it. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is don't make investment decisions based on presidential elections. It turns out they don't matter nearly as much as we are led to believe. According to influential allocation firm Richard Bernstein Advisors, investors have, quote, reaped double-digit annualized returns under every president except one in the last 45 years. Both Democrat and Republican presidents oversaw impressive results, starting with Carter's 12% annualized total returns, followed by Reagan's 15% results, then Bush 1's 14.6%, Clinton's 17.5%, then the one exception, which was George Bush 2. He had a negative 4.5% during his term, whose presidential terms overlapped with the so-called lost decade in equities. But those negative results were followed by Obama's 16.3% returns and then Trump's matching 16.3% annualized total return performance. Now, politics are fascinating, but they should not dictate portfolio strategy. Stick to financial fundamentals and the strategy that is best for you. Next week, we'll have the first of a two-part interview on how to retire with Morningstar's personal finance guru, Christine Benz, and our focus will be on the important but often neglected non-financial aspects of retirement. In this week's extra feature, Abby Joseph Cohen recommends a book on the history of information networks from the Stone Age to AI. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a great weekend and make the week ahead a healthy, profitable, and productive one.